For the last 3 decades, Knowledge Center at Bursa has offered technology, resources, services, space, and a sense of community. Since 1985, 14,000 titles have been collected, with care and attention to high financial literacy standards. In collaboration with a global community of institutions, we ensure access to the world's diverse intellectual and cultural economic heritage, as well as fast online services for connectivity to the financial world. Serving the Bursa Malaysia community and beyond, Knowledge Center at Bursa empowers you in your trading and investment analysis research.
Financial information at my fingertips.
Visit Knowledge Center at Bursa Malaysia today for the collections, for the services, for the sense of community.
You have suffered financial loss while investing, and you think your bank, broker, fund management company, unit trust management company, PRS provider or distributor, or their agent or representative is responsible. You need help sorting out the problem or want to seek redress. Where do you go? Sidrek is here to help you start the conversation and reach some resolution. First, lodge a formal complaint with a company that sold or offered you the unit trusts, shares, derivatives, or other capital market product or service. But you're not happy with their response. You have 180 days from their final written reply to come to Sidrek. Or if there's no written response, and it's been 90 days since you wrote to them, you don't need to wait longer. You may come to Sidrek even though you haven't received a final response yet. Sidrek first checks the eligibility of your claim. For example, is it within Sidrek's claim limit? Is it against a member of Sidrek? And so forth. If your case is eligible, we begin the dispute resolution process. All information in this process is confidential. We get both you and the member you're complaining against to sit with us and have a conversation. Documents and information will be required from both parties. No lawyers are allowed in the mediation process, as we keep the discussions informal and private. Our mediators are impartial and will hear both sides out and help parties communicate constructively towards resolving the dispute. 2 outcomes are possible at this stage. Either both you and the member agree to a settlement, or you don't. If the both of you agree to a settlement, an agreement is signed and the mediation process ends successfully. But if both you and the member fail to reach a satisfactory resolution, mediation has thus failed. But don't worry, Sidrek then proceeds to the next stage, adjudication. During adjudication, parties are given the chance to provide any further information to help their case and ask each other further questions. Our adjudicator will then study and consider all facts and information provided, including the conduct of the parties, laws, and best industry practices, as well as what's fair and reasonable. Sidrek's adjudicator will then make a final decision on the dispute and the monetary claim. If the decision is in your favor, it could be a full award or a partial award for your claim. But if the decision isn't in your favor, then no award will be made. You, the investor, will still have a choice. If you reject the decision, Sidrek will simply close the case and you may seek other legal avenues for redress. If you choose to accept the decision, however, the member has to comply with it. Once the parties have confirmed compliance to the decision, Sidrek will close the case. So let Sidrek help start the conversation towards resolution. For more information, visit sidrek.com.my or call 03 2282 2280.
Hello everyone! Welcome to this webinar brought to you by Bursa Malaysia and managed by LifeChamp. Today, we'll be doing this topic, how to avoid value traps in dividend investing. Okay, my name is Shen Chu. I'm the moderator for this webinar. So it's a Friday evening, so we want to thank all of you for spending your precious Friday evening with us today. So as you know, there are many traps in the investing world, and when it comes to dividend or value investing, there are bound to be traps that attract the bargain hunters to go to buy. At the end of the day, that if we see it destroys our equities value. All right, so today we are going to discuss what are these traps about and how do we avoid these traps in dividend investing. Disclaimer, whatever we share on this webinar is only for educational purpose. In no way that we give any recommendation for you to buy or sell any listed securities that we mentioned here. So if you decide to make any investment decisions, you are 100% responsible for all your investment risks. All right, so allow me to briefly introduce our speaker today. Our speaker today is a content producer of kclau.com. He has written over 200 articles on kclau.com. He is also a weekly webinar host and presenter on kclau.com. He personally co-founded dividendvault.com, which he manufactures savvy investors who can build dividend-based portfolios independently. As a dividend investor himself, he primarily invests for dividend income with a yield of about 2 to 8% per annum. All right, so he's none other than Mr. Ian Tai. So, ladies and gentlemen, help me to welcome Mr. Ian Tai to our show today. Right, welcome, Ian.
Hello, Shane. And once again, thank you so much for a very elaborated introduction of me. And thank you so much for having me here at LifeChamp at Bursa Malaysia to actually present my sharing to you guys. All right. So today we are going to do a lot of things. So need your help here. First and foremost, Shane, I have actually received a few questions regarding chat is disabled. So help us on that. That's the first one. Second thing is that, guys,
okay, let me look into that.
Yep. Guys, while I actually share with you my screen, all right, here's a few things that I need you to do right now. The first one is that if you have a smartphone or if you have a calculator right beside you, prepare that because we're going to do a lot of little bit of mathematics. All right. So if you have a smartphone, you have a calculator right beside you, that would be very, very helpful. Okay, and of course, right now, I would say that although I know that this is actually more like a webinar, but I will treat it as an online workshop because we are going to do some stuff together in this session. All right, so with that, let's begin. And of course, first and foremost, before I actually begin, just want to say once again, thank you so much, Shane, for your introduction, and thank you so much, Bursa Malaysia and LifeChamp for organizing this webinar session. So without further ado, let me just start this session. Okay, so here, guys, I mean to say I would like to start off by doing a recap on the dividend yield formula. All right, so this is actually the formula where, as you can see on the screen, the dividend yield formula is actually quite simple. We will actually take the dividends per share. All right, so DPS stands for dividends per share, but typically it is actually referring to the annual dividends per share. All right, which means it is actually dividends per share on an annual basis. We will divide it by the stock price and we multiply by 100%. Okay, so guys, if you are not from, how many of you here are not familiar with this formula? If you are not familiar, maybe you can actually type in the chat box, say I'm not familiar. But I suppose that most of you should, I believe 90% of you should be more than familiar about this particular formula. All right. But anyway, let's do a little bit of mathematics, all right? Just to make sure that you are really familiar with this formula. Okay, so guys, this is actually an example between stock A and stock B. So here I have actually give you a few information. So perhaps you can actually type in the chat box, if you may, which of the two stocks actually offer higher yield, all right? Is it stock A or is it stock B? So do some calculation and then type in the chat box which of the two stocks, which of these two stocks, is it A or B that is offering higher dividend yield? So type in the chat box, yeah? So I'm going to just read it out to you. Stock A. So for stock A, as you can see, we have the latest dividends per share, which is 7.5 cents. The current stock price is $2.50. So guys, you may actually calculate the what you call the dividend yield for stock A. And right now, let's move into, I'm going to just read it out to you for stock B. So for stock B, the latest dividends per share is 3 cents. The current stock price is actually 50 cents. So with that, you can actually tabulate the dividend yields. Okay, so with that, do we have any answers? Do we have any responses as to which of the two stocks do you think, or have you calculated that is actually offering the higher yield? Maybe you can give us, and maybe you can actually type in the feedback.
Q&A lah, type in Q&A.
Type in Q&A, yeah?
Yeah, I think today might not be able to enable chat.
Okay, so type in the Q&A box. So a lot of people are actually putting in stock B, yeah? All right. So stock B is actually offering higher yield. So one of them actually give a much more elaborated answer, whereby HS Cheng, he actually typed in, for stock A, the dividend yield is 3%, correct? And for stock B, all right, and for stock B, the dividend yield is 6%. So therefore, the stock B is actually offering higher dividend yields as compared to stock A. All right, fantastic. Okay, I believe that most of you guys got the answers correct. Let's move on. Now, here's the question. All these things, very easy, all right? It's nothing new, nothing new under the sun. So the question is this. Stock B offers 6% in dividend yield, which is 2 times more than stock A, because stock A is offering 3%. So the question we want to answer is this. Does that mean that stock B, right, is always a better investment than stock A? So that is actually the question. Is stock B offering 6% dividend yield always a better investment as compared to stock A? Okay, so that is actually the topic, the focal point for this webinar session. And with that, I would like to actually present you a case study. Okay, so we're going to go through this case study. I'm trying to go it really slow so that most of you can actually understand how value traps work in dividend investing. All right. Now, here's some objectives of this for this case study. The first one is to identify value traps in dividend investing. The second one is to learn and to assess how people, sincere investors, got themselves into value traps. Okay. And finally, the third one, which is the ultimate objective of this workshop, is to know how you can avoid value traps when you invest in a dividend stock. Okay, so these are all very important. These are the objectives. So let's get into the case study. Now, I would like you to actually turn back time to the period where it is between the end of 2020 to the mid of 2021. Okay, so just turn back the time, turn back the clock to end 2020 to mid 2021. Okay, so that's the scenario. Now, so over here we have stock A, which is actually a real stock, which is listed on Bursa Malaysia. So we have stock A. Okay, so here are the following information. Now, a lot of people will actually get all this information from stock screens, all right, like stock screeners, stock filtering systems, and whatsoever. All right, so these are the informations that people can possibly get, and which is as followed. Number one is that in 2020, the dividends per share, okay, for stock A is 6 cents. And at that time, which is 2020 to mid 2021, the current stock price, that means say you can actually buy stock A at the price of 90 cents to 1 ringgit per share. All right, so guys, type in the chat box. Type in, not the chat box, type in inside the Q&A box. Can you actually help me to calculate what is the lowest dividend yield that you can get for stock A, and what is the highest possible dividend yields that you can get for stock A? All right, so please actually do the calculation and put it in the Q&A box. Now, for some guys of you, maybe you need a little bit of assistance. So here's the thing. During that period, for stock A, you can actually purchase the stock for 90 cents to 1 ringgit. So in order to calculate the lowest possible dividend yield that you can get, what you do is that you take 6 cents, which is the dividends per share in 2020, and then you divide it by the highest possible stock price that you could have paid for this stock, which is $1. So that will be the lowest dividend yield. Whereas if you want to get the highest possible dividend yield, you just take 6 cents and you divide it by 90 cents. All right. So guys, actually put in the Q&A box. Let's see what's the answer. So the first one is that we have Henry. We have Henry Tan. Yes, you get the correct answer. The lowest is 6%. The highest is 6.67. So I'm looking at Henry Tan, Albert Wong, Benji Chim. All right. All of you guys are actually getting the correct answers. Lim On Pin, yes, 6% and 6.67%. Okay. Tan Lok, you got the first answer correct, which is the lowest dividend yield is actually 6%. Now, guys, just want to have a feedback from you guys. How many of you actually believe that 6% dividend yield in a stock, all right, listed on Bursa Malaysia is actually pretty much a good deal? All right, maybe you can put in the chat box, hey, you're getting 6% from 6% dividend yields. That one should be not too bad, right? I suppose. Okay, I believe that, okay, so in terms of calculation, I believe that all of you have got the answers correct. And some of you guys have actually responded, say, yeah, 6% seems to be pretty decent. Okay, so that is actually the case. So many people, when it comes to stock, right, they just look at what's the latest DPS, which is the dividends per share, what's the current stock price, and then they say, hey, 6%, that's not too bad, right? So maybe that's how they make decisions. Okay, so the expected dividend yield is 6 to 6.67% per annum, and I think that one is actually pretty decent. Now, here is the real lesson, the juice part. Okay, the juice part of the webinar session. This one, everyone know how to calculate. Now here we go. I'm going to give you some additional information about this stock, and then from here, right, type in the Q&A box whether or not you will still be interested to buy into stock A as an investment, as a long-term investment. Okay, so I'm going to give you some real information. Okay, so let's see. Yeah, so the first one is the past historical dividend payments. Guys, this is the past historical dividend payments for stock A. So as you can see on the screen, starting from 2014, every single year without fail, this stock has been paying out 6 cents in dividends per share. And prior to 2014, they pay out 3.4. So we have 3.75, 4.5, 3.45. But subsequently, every single year, they pay out 6 cents. All right. So now, by looking at this, how many of you are still saying that, okay, this stock has been very consistent in their dividend payout, still can consider to buy this stock? How many of you have that mindset? All right, maybe you can type in the chat box. Let's see. So Albert Wong says stagnant, no growth. Well, it's stagnant lah, but then it's stagnant, but then there's no growth, but there's no decline. So which means it's a bit like the FD kind of stuff, like, you know, 6 cents for quite some time. Albert says sell. Okay. All right, for me, let's just reserve that. Ong says yes, can buy. Kevin says yes, can buy. All right. Benji says depending on if share price is trending upwards or downwards, that one, not the information yet. All right. Henry Tan says still can consider. Okay. Casey Chong, yes. Siu Eng Yap says hold. Okay, maybe you have bought into this stock for quite some time and you are just saying that, hey, every year I'm getting 6 cents. So why rock the boat, right? when you can actually get 6 cents per annum when it comes to dividend, investing. Tanlock says can buy. Some of you says, most of you actually says yes, but there are some of you actually says, just a handful of you says no. So in general, what I can conclude is that most of you guys, even after I present you this information, the past historical dividend payments, you still say, if you have bought into this stock before, maybe you will hold. If let's say you haven't bought into this stock, maybe you will consider buying into this stock, considering that it has been very consistent in its dividend payments, and considering that you can now get it at the dividend yield of 6% to 6.67%. All right, which is based on the purchase price of 90 cents to $1. All right, so thank you so much. Okay, so these are current findings. I've already just said that, so let's just move on. I'm going to give you another information, then you consider, all right? Additional information number 2, the past historical shareholders' earnings. Okay, so I'm going to give you the earnings of stock A, all right? This is the annual profits from the business of stock A, okay? So here we go. As you can see, we have 11 years worth of shareholders' earnings for stock A. And over here, I've actually prepared this graph, okay? This graph. And all right, so everyone just jump straight into the chat box, because it seems that the chat box is now working. And now I'm giving you this price. I have already give you this this sort of what do you call this sort of earnings graph. Guys, help me, all right? So you can actually respond at the chat box right now. Tell me, all right, based on the shareholders' earnings of this company, are you still interested to buy? And why? Right? Put in the chat box. Okay. So now we have Albert Wong says not encouraging. All right. Benji Chim, no. Albert, no. Buff Lim, no. Maslan says steady earning. Okay. Eng Seng Hock, no. Albert Wong says earning struggling. Wu Yingxi, earning not consistent. Earning no more growth. That's from Arif. Casey Tan, earning decline. Earning reducing. All right. Company losing money. Company did not lose money. All right. Decreasing profits. Lily Pop. Yes. All right. So the thing is, now most of you guys now can see some picture. Okay. Number one is that to interpret this graph, let me just explain. All right. This represents, so these are all positive figures, all right, of stock A. So these are the shareholders' earnings. So when there is a positive amount like this, all right, which means to say every year stock A makes profit, all right. Every year stock A, they report profit. Very good. Okay. Now, some of you also observe it correctly, whereby on a yearly basis, all right, here we see that the profit has been growing. Okay. But some of you are very sharp. They see that from here onwards, stock A's shareholders' earnings have been declining. Okay. Can you see that there's a decline in shareholders' earnings over here? So what I would say here is that, okay, for stock A, okay, the profits have increased, but it's only up to 2015. Now we are looking at this stock at 2020 and 2021. And over here, we can see that for the past 5 years, this stock, when it comes to earnings, it has actually been declining. All right. Still profitable, didn't lose money, but earnings decline. Now, considering this, let me ask you a question. All right. Here is a question, guys. Type in the chat box. All right. So the question is this: would you value stock A based on its ability to earn A, 50 to 60 million per annum, B, 35 to 45 million per annum. Type in the chat box. Is it A or is it B? Now I'm going to just go back. All right. I'm just going to go back to this slide. All right. As you can see, in 2015, it made 54.7 million ringgit. So which means that, are you going to value the company based on 54 or 55 million, which is 50 to 60 million range? Are you going to value the company based on this? Or are you going to value the company based on 35 to 40 million? What say you? All right. So type in the chat box. So a lot of you are going to say B, which is correct. All right. So we have Ben O says, doesn't have dividend policy yet, giving and growing dividends. Now, the thing is that for stock A, the dividends have been stagnant. It didn't grow, it didn't decline, all right? So it didn't grow, it didn't decline. But if you look further, the earnings for the past 5 years have declined, all right? Have already declined. So now the thing is that when it comes to valuation, the thing is that most of us will actually value the stock based at 40 million, not 50 to 60 million, all right? Because as a business person, we only value a stock based on its ability to make its profits. And the ability, as shown in 2019 and 2020, is about 35 to 40 million. So guys, if you have been answering B, I'm with you, all right? Now, let's move on. Okay. So now you have actually get to know a little bit more about this stock. So we have already known about, okay, information number 1, payout 6 cents in dividends. You can buy it at 90 cents and 1 ringgit. So you're going to get 6% to 6.67. So a lot of you says, wow, 6%, very good return. And then some of you actually, and then I review another piece of information, which is the dividends have been stagnant. So maybe just 1 or 2 of you says, no, I'm not interested in the stagnant kind of a dividends. I'm going out. But many of you still say, yes, okay, still worth considering. Now we can see that when I review another information, which is the earnings, okay, the thing is that some of you are now, yes, maybe I should change my mind, you know. Am I going to invest in a company that is reporting declining earnings? Okay, now you start to see the shift in terms of thinking. So now I'm going to give you another piece of information for your consideration. And that information is the stock price. All right, so I won't actually tell you what stock it is. It's definitely a stock listed on Bursa Malaysia. It is definitely a Berhad. So here is the price that you can actually see over here, which is 90 cents to $1. Okay, it's here. Of course, when I prepare this slide right now, it's 75 cents. So definitely this is a value trap. But the thing is that, can you see that assuming that if you're here, and it seems that the price has stabilized over here, can you see that the highest stock price here is at $1.30? All right. The highest for this stock, right, is $1.30. It goes down to 90 cents to 1 ringgit over here. So imagine you're here. Would you say that, how many of you actually think that, is it possible for some people to think that this stock is selling at a discount? All right. How many of you say that this stock, right? How many of you can see that some people will say that, hey, last time this stock is actually selling at 130. Now it's selling at 90 cents. Now it's selling at 90 cents and $1. Can you see that? How many of you can see that? Based on at that time, some people will actually think that discount. So Albert says no, selling at a premium. Casey Yap says no discount, EPS is declining. Woon Yin Si says no. Okay. Benji says no, earning is dropping, price also drop. Okay. So guys, here's the thing. Based on this case study and the feedback received, right? So now here's the thing. For stock A, it is, I believe, in a way, because I actually reviewed the earnings for each and every single year for stock A. Therefore, you can see that, earnings drop. So therefore, it's justifiable that the stock price has fallen. But now I would like you to say, okay, I won't tell you actually which stock lah, all right? You can actually have your guesses. But the thing is this, all right? The thing is this. How many of you just reflect, how many would say that it is actually very possible for an investor to actually look at stock prices only without looking at the annual reports and all this kind of stuff and conclude that the stock is actually offering at a discount? It used to trade at 130, now it's trading at 90 cents and $1. And the thing is that it's offering 6% to 6.67% per annum. All right. So from my point of view, I believe that some investors may have just looked into these two and conclude that this could be a very good investment. But from my point of view, here's how I see things. Some of you have already jumped the gun a bit and have already gotten the answer, but I'm just going to elaborate further, all right, how I actually approach this. Of course, the thing is that, has stock A become cheaper? Some of you have already answered the question, all right? The thing is that, a lot of you actually have already spoken and say, no, the stock is not exactly cheaper, all right? Some of you have actually gotten the answer. But over here, I'm going to just review to you the calculation, all right? Why is it that stock A, despite a falling stock price, may not necessarily be cheaper? Okay. So here's the calculation. Okay. Here's the thing. So I'm going to just review to you the difference between price and valuation. So price is what people see. Some people only see stock A used to be 130. Okay. Now it's at 90 cents and $1. So they see, have already dropped by 30 cents. So they see that as a discount. People only focus on price. But for investors, we always want to calculate the valuation ratios. So if I'm going to just do a simple calculation on the valuation ratio for stock A, here's how it will look like. So over here, we can see that the shareholders' earnings are dropping, right? Can you see that? The shareholders' earnings are actually dropping. So therefore, when it comes to the earnings per share, it has actually followed suit. It has, as you can see over here, stock A's earnings per share have also fallen, all right? It has fell from 6.84 cents and it kind of like dropped to 4 to 5 cents, all right? So from 6, close to 7 cents, dropped to 5 cents. So here's the closing stock price. So as you can see, the stock price has fallen. All right, stock price has fallen, but when I calculate the PE ratio, give you a simple tutorial about PE ratio. So PE ratio is where you take the stock price, which is the P, and then you divide it with the E, which is the earnings per share. Okay, so you take RM1.29, you divide it by 6.84 cents. So therefore, your PE ratio is 18.86. All right, so that is for 2015. Over time, the stock price may drop, but then the PE ratio, can you see? It didn't exactly drop. The PE ratio, okay, which is the price measured against its earnings, we are comparing price and earnings. Can you see that the PE ratio didn't drop? It remains at 18, 19, 18, 18, 19, 17, 18, 18. So from an investor's point of view, although the stock price has fallen from $1.30 to $1, but the PE ratio never really dropped. Okay, it never really dropped. So what does that mean to me? It means that when it comes to the valuation, it didn't actually get any cheaper. It didn't get any more expensive. It just remained the same. However, because the earnings have actually fallen, so I would say that it is justifiable that the market, the share price has fallen together, and it was reflected, the value is actually reflected that way. All right. So at this point, I just want to ask for your feedback. Did I explain? Can you see, how many of you here can already see that this is actually a value trap? And how many of you can actually, how many of you actually like understand or see a bigger picture on, oh, this is how you actually avoid value traps? Maybe you can actually type in the chat box, give me some feedback, and let's see what's the response. Okay, so we have Henry Tan who says understand, thank you so much. Wu Yinxi says depend on valuation, margin of safety, not stock price. Correct. So guys, investors, right, we don't actually focus on stock price. We always focus on the business. We always want to know the economics of the business model, the finances, and the valuation. Benno says price drop, but PE doesn't drop because profit is dropping gradually. Correct. That's why as an investor, we don't actually talk about, we don't look at, oh, some stock has actually fallen. No, we say that, okay, some stock, the price has dropped, very good. But as an investor, we always shift our focus back into the profits and the business model. We want to see whether or not, is there any deterioration when it comes to its fundamentals. Okay, so that is actually very important. Okay, so that is actually very good. I believe that based on the feedbacks given, I believe that some of you have actually gotten the picture. And guys, if you have any questions along the way, maybe you can put in the chat, in the Q&A box, and I will be happy to actually address them as much as I possibly can. Okay, so with that, let's continue on with the webinar or the workshop. Okay, so as you can see, the stock price has actually fallen. So if you actually spotted that this is a value trap, it is, and the stock price has actually fallen down to 75 cents. Okay, and once again, I won't tell you what stock is this. Okay, so stock price has dropped, but stock valuation did not. Okay, so once again, if we, let's say, go back to the question, has stock A become cheaper? So for people who just look at stock price, they think that it is. That's why they fall into, that's why they will be more prone to fall into value traps. Whereas for people who are looking at earnings, then the answer is no, all right? Because we always tend to look at the stock as a business. So therefore, we always want to value a stock based on its earnings or the ability to actually generate the earnings. Okay, forget about price first. We always want to focus first on the earnings. Okay, so this is actually the summarized findings of our first case study, which is this. The expected dividend yield is 6 to 6.67% per annum. A lot of people say, hey, very good. Consistent dividend payout since 2014. A lot of people will still be thinking, very good. What changed people's mind is earnings declined from since 2015 to the 45 million a year in 2020. So that is actually what started to shift people's mind. And a lot of people now start to see that the stock price decline seems to be justifiable because the stock earnings have fallen. And when you do the PE ratio calculation, the stock valuation has remained the same. Okay, when the stock valuation remains the same, it can only mean one thing. It means that the fall in stock price is justified. It's reasonable because it is actually backed by falling earnings. Okay, so here are some lessons to be learned. How do people actually fall into value traps? Okay, now these are the these are the process. So I'm actually looking at how the investor, how they actually make decisions, how they make stock buying decisions. So what I can gather is this, all right? Let's take a look. The first one is that the first group of people is that they take out their smartphone, they downloaded some stock apps, and then they say, hey, they only look at current dividend yields. All right. The first thing they look at is current dividend yields. Maybe they use the filtering function and then they just say, find me the highest yield. And then they base their investment decision on that. Okay. So that is their first step. And the thing is that after that, right, many of them, they actually fail to look at past historical dividend payments. Okay. So that's the first way they fall into value traps. And even after they have looked into past historical dividend payments, many more will actually fail to look into past historical shareholders' earnings. They fail to look at sales, profits, cash flow, and all this kind of stuff. All right. So if let's say people don't actually look into all this kind of stuff, then they are even more prone, all right, to actually fall into value traps. Okay. So therefore, here's what I'm trying to say. Looking at past historical dividend payments is like your first line of defense. But if you look at the shareholders' earnings, where you also would look at sales, profits, cash flow, and all this kind of stuff, gearing ratio, the balance sheet stuff, that is kind of like a second line of defense. Okay. So this is like a two-tier security kind of stuff in order to avoid yourself from falling into value traps. Okay. Another way of how people will tend to fall into value traps is that they tend to compare the current price with what was traded in the past. So if let's say a stock is trading at $2 and it has dropped to 150, then they think that that's a discount, which is not really the case. Okay, look beyond the stock price. And last but not least, how do they actually fall into value traps? Is they fail to calculate PE ratio. Okay. So the thing is that from Maslan, how do you know the PE ratio? Well, like for example, you take the Google thing, you can take Google or Yahoo, the stock price, or even Bursa Malaysia, take the closing stock price of every single year, take the earnings per share of that year that you want to calculate, and then you calculate the PE ratio. Okay, so it's just a matter of practicing how to calculate the PE ratio. Okay, so that's how I actually calculate the PE ratio. Now let's move on. So this is actually what most people actually do when it comes to this is actually how people think, and this is how the process is like for many people. First is that they look at stock screeners, then they filter out stocks that offer the highest dividend yield. All right, so let's say from 900 stocks in Malaysia, we have 900 stocks. They use stock screener. They kind of like filter out like, oh, we have 50 stocks or 30 stocks which are offering more than 5% in dividend yield. Then they start to find the stocks that they can recognize. Oh, maybe this stock I recognize. I know the brand. Some stocks, like I never heard before one, then they just dismiss it. All right, then they will gather another maybe 10 stocks or something like that. The 10 that they kind of like recognize. And then they see which one they can afford. Maybe some of the stocks they recognize, but then they're offering at above 10 ringgit per share. Some of them maybe at around 1 ringgit, 2 ringgit per share. So maybe for some of them, they will actually consider that, hey, maybe I should just buy the one that I think I can afford lah. And then last but not least, they just buy. If you are the type of investor who go through this kind of process, you are most likely to fall into value traps. Now, let's talk about another type of process. Okay, now we are going to shift. Okay, so the question is this: I will actually share from my own personal experience on how do I actually avoid value traps when I invest in the stock market. Okay, so this one is actually a little bit more personal. So this is actually where how I actually manage my own portfolio. So the first one is that I will always have to be very mindful of my own investment objectives. Okay, So these are the investment objectives. My personal one. Number one, for myself, I wish that I would like to earn consistent growth in dividend income over the long term. So which means to say the dividend income should grow over time. The second one is that, of course, if our FD rate is actually at 2%, let's try to beat 2%, all right? It can be 3, it can be 4, it can be 5%, okay? Although there's a saying, the higher the better, but then it's not always the highest dividend that wins, all right? Because for me, it is always the business, the source of the dividends, which is the business, is more important than the dividend yield itself, okay? So I tend to prioritize on the business, the quality of the business, over how much dividends I'm going to get from the business, okay? So I'm actually quite mindful of that. Now, so this is actually my process, all right? So whenever, let's say, for example, I found a stock, okay, whatever stock that is, it can be ABC Berhad, okay? So here is what I would, so I have this sort of a filtering process to actually decide for myself whether I should invest in this stock or not. So this is actually my own process. The first one is that I will study the business model, okay? So before I even look at the stock price, I'll look at the business model first. Because what I want to find is actually a stock where the business model is resilient and sustainable. All right, so I always have these two things in mind: the resilience of the business and the sustainability of the business. Why? Because in the stock market, because in the economy, a lot of things can happen. There are a lot of changes, a lot of fluctuations, a lot of volatility, a lot of uncertainty. So what I want is a business, all right, whereby the people that runs the business, right, they can actually continue to run it sustainably. They can actually be resilient and face all these things head on, and they can actually thrive in these situations, all right? And if I can find businesses like that, I hope that I can own. I really hope that I can own them, lah, right? So which means to say I always want to find the tough ones, all right? Because tough times may happen, but the tough ones will last. So that's the first one. Study the business model. After that, if let's say I find a business model that is resilient and sustainable, it should translate into very good financial, all right? Very good financial figures, good financial management. So this should actually translate into a stock which would have a track record 10 years, all right? Because I always use 10 years as my benchmark. In that 10 years period, the stock should actually deliver consistent growth in sales, profits, all right, which is revenues, earnings, operating cash flow, and of course, with the operating cash flow, they can pay out increasing dividends. And when it comes to balance sheet, I have a preference for stocks that have a healthy balance sheet, whereby the gearing is low, ample of cash, good current ratio, all this kind of stuff. Okay, so that is actually my step 2. First step, business model. Second step, the financials. The third step is like, okay, let's say I found a stock. The coffers is big, good, very good financial management. The thing is that with that money in hand, how on earth the company is going to grow? So I will actually check out. I also want to find out what the stock is doing, what the management is trying to do, what are the efforts that the management is going to undertake in order to continue to grow the business. So that's the third one that I will look at. So as you can see, based on these 3 alone, I will study the annual reports. So because all these things, these are not stuff that you can speculate. These are stuff to be read in the annual reports. So I tend to visit Bersama Malaysia website very often because these are places where you can get all this information. So that is step 1, 2, 3. Now, then only we move into step 4. So if the business is good, then we look at the stock price. From there, I will calculate the PE ratio and the dividend, and I will calculate the dividend yield. I will not just calculate the current PE ratio and dividend yield. I will backtrack 10 years to find out the past historical PE ratio and the past historical dividend yields. All right. From there, I will calculate the 10-year average and I will compare it with the current. From there, I can actually tell whether or not the stock is undervalued, fairly valued, or overvalued. That's my formula. Okay. So that is actually the first 4 steps already. And after that, I will go into step 5, whereby if let's say I find that the stock is undervalued and the business is solid, okay, then we start to accumulate this kind of stock. So that is actually my own process. Okay, so you can refer to this. All right, you can refer to this and see whether or not it is helpful for you. But this is actually my own standardized process. Okay. So Zachariah Thomas, you ask, need to consider cash flow also? Yes, very important. Cash flow is the most important thing that I will consider, because another way to avoid value trap is this. You don't want to find a company that consistently deliver increasing profits, but no cash flow one. Cannot. All right. You must have profits, and then you also must if let's say the stock has delivered consistent growth in profits, right, the operating cash flow, right, must also consistently grow on. It cannot be negative. If let's say the profits are growing, but then you find that the operating cash flow, right, is cash outflow one. That is something very wrong with that. That is something very wrong with the stock already. Then to me, right, increasing profits but no cash flow is a definitely no. So I will actually look at cash flow very intensely, because I want to make sure that the profitable company also comes with cash flow. So that is something that I am very particular about. And especially as a dividend investor, cash flow is a must. All right. You cannot buy a stock without cash flow. Okay. So let's continue. So that's actually my process. And with that, let's move on to case study number 2. Let's take a look, right? Case study number 2. So guys, if you already understand case study number 1, case study number 2 should be a breeze, should be very easy. But anyway, let's go through this together. Now let's turn back time to mid-2020, okay? So we found a stock, which is stock B, where, all right, I've already done the whole thing. Okay, let's assume let's play cheat a bit whereby we already assess the stock, all right? And we know that the business model is resilient and sustainable. Okay, whatever the business is, it's resilient and sustainable. That is step 1 already. So now let's look at step 2, the financials. So I'm going to give you additional information. Number 1, past historical shareholders' earnings. Okay, this is the shareholders' earnings of stock B, past historical one. Okay, now over here, how many of you say that this company, when it comes to shareholders' earnings, it looks pretty healthy, pretty good? Every year got growth one. How many of you would like to how many of you say that this stock, right, the earnings is actually quite decent, and it'll be nice to actually hold on, it'll be nice to own some of the shares of this stock? So Albert Wong says okay, Henry Tan says agreed, Lim Ong Ping says yes, many yeses. All right, so everyone says everyone is like yeah, very agreeable to this. All right. And of course, if let's say you're the guy who actually bought it in 2009, congratulations. All right. Everyone will be very envious of you. Okay. Now let's move on. So this is the current findings thus far. Business model, resilient and sustainable. And we can see that the earnings have been consistently growing. All right. 2009, 2019, growth. Very good. Okay. So earnings first, all right? So step 1, done. Step 2, done. Let's move on to the next information. Now I'm going to give you the past historical dividend payments, okay? Now this is the past historical dividend payments, okay? As you can see, it has actually increased from 41.3 cents in 2009. So if you have been a shareholder of this company since 2009, you'll be getting 41.3 cents in dividends, 45.5, 48, 50, 52, and it goes all the way up to 73 cents in 2019. How many of you here are interested to, how many of you say that, the dividend payment track record is actually very healthy? How many of you agree that? Maybe you can type in the chat box. All right. Okay, so once again, it's all yeses. Nobody says no. Okay, not yet buy, not yet buy. It's just that, okay, we are doing our due diligence as an investor. So far, I haven't reviewed the stock price, but then the earnings are good. The business is resilient. The dividend payouts is good. Very good. Now let's move on. Okay, now I'm going to give you the stock price. The stock price, okay? So this is it. This is where we are right now, mid-2020. So we have, so this is actually the stock price movement for the past many years. And right now, this stock is actually offering at 16.42. Okay, so it used to be 25, now it's 16.42. So the question is, how many of you how many of you say that, hey, this is worth considering? Maybe this is something that we will be looking at. We will be calculating the valuation ratio. It's worth your time to do the calculation. How many of you agree that? Say, put it in the chat box. Okay, Marcus Chan, I won't tell you what stock lah. Okay, so a lot of people say yes, agree. Okay, not yet buy. Doesn't mean that the stock price last time it used to be 25, now 16, it's a buy. Not necessary, but at least based on what I have actually gathered, which is the business fundamentals, the financial track record, the dividend payment record, everything seems to be okay. There is a stock price drop. Fantastic. Time to do some calculation on valuation. Okay, so I have actually done the figures. So this is what happened. This is what happened. Okay, so as you can see, the shareholders' earnings from 3.4 billion, it grows all the way to 5.5 billion. So it's growing. The earnings have grown. So the earnings per share have also grown. Okay, so which is very good. Now, as you can see, the closing stock price, it also have grown. So earnings grow, EPS grow, the stock price has grown. So now when it comes to the PE ratio, can you see this or not? Did the PE ratio grow or not? So in 2010, in 2010, as you can see, it's at 14.9, 13.45, 14, 16, 14, 14, 14, 14, 17, 13. Okay, how many of you here, let me just change this back to slide share. How many of you see that closing stock price grow, earnings per share grow, shareholders earnings grow, but PE ratio actually didn't really grow? All right, you see here the PE ratio didn't grow. Never mind. All right, it's just maintained. That's good enough. But here I have actually calculated the average for you. So the average, the 10-year average when it comes to the PE, right, is actually 14.9. So which means to say, okay, so which means to say for me, as an investor point of view, I would say that let's say I want to invest in stock B. And I calculated that the 10-year PE ratio average is 14.9. My job as an investor is to make sure that stock B's fundamentals are solid first. And if the PE ratio is below 14.9, I would say I will see that as being undervalued. If let's say the PE ratio, the current PE ratio at the time is about 14, 15, 14 or 15 like that, then I would say that company is, at that time, the stock B, all right, it was fairly valued. But if let's say stock B's valuation, the PE ratio has gone up to 16, 17, 18, or even 20, then I would say that one is a bit overvalued. Okay, so that's how I view valuation. Okay, guys, do a little bit of calculation for me. So let's do a bit of calculation. So here is the latest earnings per share. So the latest earnings per share is 142 cents. So it's 1 ringgit and 42 cents. Current stock price is actually 16.42. So do me a favor, would you? Can you actually calculate the PE ratio of this stock? And let me know what exactly is the current PE ratio. So Henry Tan says 11.56. How many of you are getting 11.56? Yes, a lot of you are actually getting 11.56. Eng Seng Hock 8.65. No, not this time. Not this time. It's actually, we are calculating PE ratio. So you take the price, we divide it by the earnings per share. So you're supposed to get 11.56, just like many of us here. All right. So when you get 11.56 and then the business fundamentals is solid, can you see that over the past 10 years, the lowest PE is 13.45, average is 14.9, the highest is 17.15, now it's 11.56. Who's interested? So here, who is interested to buy this stock, whatever that is? So Siu Eng says buy, Vincent Tan buy, Albert says buy, I believe so. I believe you. Shohaimi says me. Yun Xiang buy. Safia buy. Lim On Ping buy. Maslan buy. Muhammad Iqbal buy. Stephanie Chiu buy. All right. Maslan says Sapu. Okay. Buy. All right. Very good. Henry Tan says check dividend yield first. Of course. Of course, I have to check dividend yield. So PE ratio is one way. Dividend yield is another way. All right. So now the thing is that you can also repeat the same process with dividend yield. So which means this time you put here dividends per share and then you calculate the 10 years dividend yield, you calculate the average, and then from there you can actually see, you can actually do the comparison and find the valuation. All right, which I have actually done it here. All right, so guys, let me just change this. All right. So which I've actually done here. So let's take a look together, shall we? So we have the dividends per share. As you can see, it's growing. Stock price is the same. Can you see that the dividend yields, it goes from 3.49, 3.59, 3%, 2, and then we have a bunch of 2s, and then we have 3.76. So the 10-year average dividend yield is actually 3.02%. Okay. All right, so guys, let's help me to calculate the latest DPS. All right, the latest dividend yield for stock B. So how do we calculate? Very simple, yeah. Take the latest DPS figure, which is 73 cents, divide it with the current stock price, which is 16.42. Take 73 cents and divide by 16.42. Guys, what would be your result? How many of you here are getting 4.44 or 4.45? All right, type in the chat box. A lot of you are getting either 4.44 or 4.45. All right, the difference is negligible. Okay. Yes, everyone is actually getting the correct answer. Now, the current dividend yield is actually 4.45. So the thing is that I'm looking at the past historical. Okay, the past historical. So the lowest is 2.02, the average is 3.02, the highest is 3.59. Now, for this stock, you see that the business model is strong. You see that the earnings are good. You see that the PE ratio is the lowest. The dividend payment track record is good. And right now, if you buy this stock, you can get 4%, 4.45, which is actually higher than the highest dividend yield in the past 10 years. How many of you would like to buy? Okay, so Henry Tan says buy. Shu Haimi says buy. Okay, most of you will say buy. All right, thank you so much. Now, so here is the current finding. Business model, resilient and sustainable. Consistent growth in earnings and dividends. PE ratio below is 10-year average. Current dividend yields above its 10-year average. Just buy. All right. So that is actually the system, or that is actually the process that I use in order to actually find discounts in the stock market. Okay, so here is actually the end result of this stock. All right, so here is a stock. It's definitely a Berhad. I won't tell you what stock is this. But if you buy it at $16, you will be buying it here. Right now, as you can see, there is some sort of a capital appreciation lah. All right, after you have purchased this stock. All right. Now the question is this: how many of you see the difference between case study 1 and case study 2? Type in the chat box for me. All right. How many of you actually can see the difference between 1 and 2? All right. So as you can see, the similarities between the two is that both stock A and stock B, both of them have falling stock prices. But why is it that we actually don't buy stock A, and why is it that we buy stock B? How many of you now can see the difference? All right, please type in the chat box. Okay, Henry Tan says can see. Stephanie Chiu says can see. Wu Yin Si says, is it okay to use 5 years average? Now the thing is that okay, like it depends. Sometimes I view investing is like lending money lah. All right, we are basically parting ways with our capital, put it into some company so that the company can actually generate wealth. Now, so if let's say we are talking about lending policies, so it depends on, let's say you just imagine yourself as a bank manager, or you are one who decides on the lending policy or the credit policy lah. Okay, so you can use 5 years. For me, I just use 10 years lah, because I'm a little bit more conservative lah, and that's how I said it lah. But if you think that 5 years is good enough, then also can lah. All right. But I use 10 years because I see that in the 10 years period, anything and almost everything that can happen in the stock market will happen lah. So I just want to be even more conservative. That's about it lah. But the thing is that, all right. So I believe that a lot of you are actually beginning to see that, which is a good thing, all right, which is a good thing. Everyone can see that the differences between stock A and stock B. Okay, very good. So guys, once again, this is definitely not the process that I use when it comes to buying stocks in the stock market. I don't necessarily use a lot of stock screeners. I don't actually just go with the highest dividend yield and just buy if it's affordable. All right, so I don't do that. Rather, over here, I would like you to like compare the differences between the investment process, the top process, okay, the whole cycle, the whole plan. All right, so this is the difference between the two. What most people who actually fall into value traps do is that stock screeners go with the highest dividend yield, find something that they can recognize, pick the affordable ones and just buy. So if you are going into that, it's very easy for you to fall into value traps. But if you are, let's say if you are much savvier, what you will do is that you'll be, actually it's not exactly savvier, it's actually more hardworking, that's all. You just need to be a little bit more diligent. You just need to read more only. What you will do is that you will download the annual reports at Bursa Malaysia website, and then you just study the business model of the stock. You check the financials. You kind of like find out the growth initiatives, do the valuation, and then you will buy if it's undervalued. So this case, you will have a better chance of actually getting valuable buys, all right? And you can actually avoid yourself from a lot of unnecessary value traps in the stock market. Okay, so with that, I would like to thank you for your attention. And maybe you got questions that you have in mind. This is the time to do it. And with that, I would like to pass the control back to our moderator of the day. Shane, back to you, man.
Thank you so much, Ian, for doing a very exciting session for us, how to avoid value traps in dividend investing. All right. So if you have any questions for our speaker, please write them in the Q&A box, not the chat box, okay? Write them in the Q&A box so we can manage your question effectively. So the first question is, what is forward PE ratio and what is trailing PE ratio?
Good question. But actually, I didn't But actually, I didn't use any of the two myself, lah. All right. Actually, I didn't really. I kind of read it before, lah.
Okay,
But
maybe I
then,
help to.
yeah, maybe Shane, you can help to actually answer this question because I didn't really use these two.
Yeah, I think trailing PE ratio means that it is the the recent 12 months. Okay, there's the prevailing PE ratio at the current moment. But the forward PE ratio means that you have already forecasted, what would be the earnings per share in the future in the next 12 months. Then you use the forward earnings per share and you take in comparison to the current share stock price. So that is forward PE ratio. But of course, you can easily Google that if you want to have a better understanding of it. All right. So if you want to forecast the future, people will take forward PE ratio. Yeah. So if the forward PE ratio is lower than the trailing PE ratio, that means that there is a potential that the earnings will be increased in the future.
Okay. All right. Maybe.
All right.
Yeah.
The next question is, does net asset per share play a part in your decision making before you consider to buy a share?
In a way, yes, but in a small way. Because why? The thing is that how I view stocks is that stocks to me is like business, and then business, right? Whereby it's actually I see in terms of its income productivity. So to me, I will put a lot of weightage on its ability to generate earnings and dividends. So therefore, the PE ratio and dividend use will be the top priority. Of course, I also understand that based on the balance sheet, the stocks, right, they will own some valuable assets. So in that case, I will also check out its net assets per share, especially when it comes to REITs. Then yes, you can actually use that a lot, and then you can actually compare the price to its book ratio. So yes, in a small way, but not every single stock. The ones that are asset rich, I will probably do that lah. Yeah.
All right. The next question by Simon is it usually after the dividend payment, the share price will drop?
But I mean to say that one is not too important. I mean to say because why? Because we don't actually try to play around with that. I mean to say sometimes okay. So the thing is that what's more important in the long term, what's more important in the long term is that whether or not the business can continue to grow its earnings and dividend payouts. That one is the one that will actually justify the stock price in the long term. So in the short run, okay, occasionally I mean to say it may matter very little whether or not you buy a stock before it declares its dividends, after, or maybe you buy it before the X date, and maybe you buy it before. Let's say right now, okay, let's say right now, July 15, right? So a lot of stocks, their cut-off date is on the 30th of June. How many of stocks do you know that have already have already come out with their Q2 financial report? Not many. Okay, so right now we are in a period whereby the dividends are not yet declared. So maybe a few days time, maybe a few weeks time, there will be stocks who say, "Oh, I have already finished the accounting. I already come out with the financial report, and from there are some profits, and then they declare some dividends. Now we have an X date. Then maybe the stock price will move a bit, but it doesn't move that much, lah. All right, honestly, but that is actually another period, and then we have another period whereby it is after the X date. All right, then maybe the stock price may adjust a little bit here and there. But to me, right, regardless is whether it's now the first period, the second period, which is after they have declared the dividends, but they haven't paid out, they only declare the amount of dividends and the X date. And the third period is you bought it after the X date. It doesn't really matter much in the long run. So don't look at this don't consider this too much. I mean to say, consider the income productivity of their business. That one is the more important thing. Yep.
All right. Thank you so much, Ian. The next question is by Zachariah Thomas. If you had bought the stock at lower price and the price has risen substantially in later years,
Mm.
do you take capital profit if the gain is multiple times of the annual dividend payout? Like the dividend that like the capital gain is 5 times the annual dividend. So what would you do?
Capital gain is 5 times the annual dividend. It depends. I mean to say, it depends how short. How short is that? How short is that lah? I mean to say, how short is that rise in stock price? That one is the thing. I mean to say, there are 2 types of capital gains, right? That investors can. There are 2 types of capital gains. The first one is that it is actually justified by business growth. So what do I mean by that? So it's like, let's say if we go back here. So like this, right? So we see that the earnings of the business of stock B has grown. So therefore, the closing stock price of stock B has also grown, but then the PE ratio didn't really grow that much. So in that sense, I would say that this kind of capital appreciation is kind of like justified by the business growth. That's the first one. But then there's a second one, which is the illogical one. It's like, don't know why the stock price just go up. Everyone is just crazy one. Then if let's say everyone is crazy, right? Which means to say it's actually the capital gain is kind of like fueled by no logic one, which means a lot of traders and speculators all come in and buy the stock for no apparent reason, right? Then maybe you can consider and realize your capital gains and move on. The right time to actually take capital gains is when your next door neighbor, your colleagues, the people who never really should be in the stock market, they are suddenly in the stock market, and there's so much excitement right now, right? That's the time That's the time to get out But then usually we don't actually hope for that Okay, usually we just usually for me, right, we don't really sell stocks a lot We just actually keep whatever we have.
All right. So that is how you approach investing
Uh-huh.
So in your assessment, how do you react to special dividends?
There are 2 types of stocks. Some stocks, they really every year pay special dividends. Then the special is no longer special. Then I would just consider that as okay I can factor into my assessment when it comes to the dividend use calculation. But there are some stocks whereby once in every 5 years they pay out special dividends. Usually when it comes to calculating the dividend yield, I will exclude that because that is supposed to be special. That was just bonus. All right, so I won't consider that. The mistake, another way of people getting into value traps is that they consider that as hey, dividend yield. No, if the special dividend is for that year and it's gone, it's gone. All right, unless every year you get special dividend. So for me as an investor, I want to see annual income productivity. I'm valuing the business based on that. I'm not valuing the business based on the ordinary and the special, because special is not for every year. It's just once in a while. Yeah.
All right. Thanks, Ian. The next question is by David. If a company pay out dividend, but want shareholders to reinvest on the newly issued shares, which means no payout cash for the first time in the past 10 years, is it considered not good to shareholders, or is it considered okay?
That means the company has been paying dividends for 10 years, and then suddenly they have a change of mind, say, I don't want to pay you dividends.
No, ask you to reinvest into their new shares.
Depends what is the offer. All right. Depends on what is their reinvestment plan. What is their price? What is the offer? But usually I will still like to receive dividends because dividends give me the option. I don't need to invest in the same stock. If you give me cash, I may want to buy into another stock. Then if you give me cash, then of course I will have the option to actually choose between this company and many other companies. So cash gives me option. I'll still take. If let's say the deal is not so nice, then I will take the cash.
Okay. So would you consider stocks that give only 2 to 3% dividend yield?
It depends on the business, okay? It depends on the business. So it depends on why is it paying out 2 to 3%. So some stocks, right, they say that they are going to invest a lot into R&D, and then you kind of like the stock because you like the business model, you like the innovation, you like the growth initiative that the management is actually undertaking to actually grow the business. So these are companies whereby they'll be a little bit more dynamic, they're a little bit more ambitious, and they are pursuing growth as they believe that growth is their best way to actually maximize the shareholders' wealth. So if that is the case, of course, I'm not saying that every single research and development activity or every single growth initiative, it will work. But then the thing is that if let's say they have a team whereby this team has a bunch of professionals and they really have the track record of coming out something really good, and the good stuff that they actually come out with, right, they actually add value to their customers and to the society as a general whole, and they are continuing to do that, and they are willing to invest their profits into this kind of activities, I say why not lah? So I don't mind foregoing some dividend yields to hold on to actually acquire these companies because they are very innovative. I don't mind that lah.
All right. So Stephanie would like to ask, so what kind of businesses or sector do you like to invest?
Actually, I have my bias, but then I won't personally review lah. But then the thing is that okay, I have some prerequisite one. Number one is that I like something that is recurring. So number one, it has to be recurring. All right. Number two, I tend to look at cash flow one. So anything that okay, so to me there are two different types of businesses one. Or I would say two different types. I would say that I like businesses that they are either cash businesses. Cash businesses means to say when they do business, right, they generate cash sales. It's like let's say you order coffee from a cafe, you have to pay cash in order to consume the coffee. So that is actually cash business. I may not like something like a stock whereby they generate revenue. I bill my customer, all right, so there'll be trade receivable. I bill my customer and then I allow him to pay me like 6 months down the road. Then there will be then see how good the company is when it comes to cash collection, all right, and whether or not they can recover bad debts or not, that is actually another thing. So I like cash businesses a lot. I like the ones that are very good in if let's say even if they're into credit businesses, I don't like it when the debtors days are very long one. I like it. I like the short one. That kind of thing I like. All right. Of course, the business model must be resilient. Recurring income, cash business. These are the three characteristics of the businesses that I like. So I'm not very sector specific. That kind of stuff.
So not sector specific just that you these are the considerations that you will take into when you evaluate investment opportunity, right?
Yes.
So in terms of doing fundamental analysis, like which between qualitative analysis and quantitative analysis, which one you place greater emphasis on?
The two should actually come together lah. All right. The best is that, of course, if the qualitative is good, then the quantitative also should follow lah. All right. But the thing is that for me, right, maybe because I'm a little bit like want to see some documentation, some proof lah. So therefore, I will look at the quantitative side lah. Because the qualitative side, sometimes I may not actually have I may not know everything I need to know. I may understand the business model. Okay, so this is a good business model, but how I say that? It's not like I have the detailed market report on what's the market share of this company. That one is, if let's say I don't have that information, sometimes I may invest without that information. All right, let's put it that way. If let's say it's not in the annual report, and I don't have it, then don't have law. But the thing is that quantitative means to say the financial report, that one is surely have one ma. So if let's say that thing is surely have, then I will usually base my investment decision on that financial report law, on that stuff lah. So I will still, I think I'm the more on the quantitative side. Yeah.
Okay. Yeah, actually there are a few questions to ask you. How long do you hold a stock normally, and when would you consider the right time to take capital gain?
Usually for us, we don't really think about capital gain or capital loss lah, because that's not how we measure. That's not how I personally measure investment success lah. Because if you measure investment success based on capital gain and capital loss, so capital gain, so you tend to like, oh, this stock is really on the rise, then you think that that's something positive. And then if let's say the stock actually drop, then you think that your investment is not working. So that's not how I measure it. So what I will do is that what we like to do is to acquire and accumulate lah. So I like to see that let's say at the end of the day, let's say after 5 years of investing, after 10 years of investing, how many of that stock I own? Because people can make transaction. Let's say you buy a stock B, for example, and then you just buy 1,000 unit, and then you trade, and then it goes up, then you make that money out of that 1,000 unit. But that's not my plan, my own personal plan. My personal plan is that if let's say if stock B, right, okay, so it's like after 10 years, right, how many stock B do I have lah? So do I have like 100,000? Do I have 10,000 units of stock B? Do I have like 20,000 units of stock B, 50,000, 100,000 units? So I'm looking in that angle lah. So that means to say I won't be looking at capital gains or losses that much lah. I think I'll leave that to the traders and the speculators, because for me, I'm more interested in the accumulation of stocks than trading it lah.
Okay, understand, Ian. Lily would like to ask, what are current ratio and quick ratio in assessing the company's financials?
Current ratio means like, just imagine this lah. Okay, if let's say one have a savings account of $100,000, and then it has about 50,000, and every year he has to pay about $50,000 in living costs and bills and whatever that he needs to survive. So you take 100,000 divide by 50,000, then you say that, oh, his 100,000 can last him for 2 years. Okay, so that's current ratio. Okay, actually that's quick ratio
That's current ratio.
Actually quick ratio should be just cash only, right? Current, because it actually involves like, oh, maybe let's say for example, Shane, I have business dealing with Shane, and then Shane promised to pay me in 1 month's time. So that one to me is an asset, isn't it? So that one is more like a receivable from Shane, which is payment due from him to me in 1 month's time. Let's say the deal is like another $10,000, so I can actually add up. That will be part of my balance sheet lah. So that one will be used to calculate the current ratio. But quick, I think, is more towards just cash only, right?
Quick ratio is when they take out inventories from the current assets.
Yeah,
because some inventories cannot be converted to cash, right? So to be safe, yeah. So when you calculate quick ratio, is to determine the liquidity of the company.
Yes.
Yeah. So quick ratio is more conservative.
And there's an add-on to this, guys. There's this preference that I like. All right. So I look at the balance sheet, right? I look at the current asset, right? So they are like cash and cash equivalent. They are trade receivables. They are inventories, or any other things that can be converted into cash within 12 months, right? That will be under current asset, right? So I look at that section of the balance sheet lah. Personally lah, I would like it if, let's say, the current, I like it if the bigger proportion of that current asset is actually cash. All right. So which means if I look at the current asset, if let's say the company has a lot of inventory, a lot of trade receivable, little cash, no good. Not my thing, not my thing. Okay. For me, I like a company where a lot of cash, not so much receivable, not as much inventory. Okay, that one, something that something I might go with that kind of company. Yeah. Yeah. So that is actually my preference.
Okay, thank you so much, Ian, for sharing with us, how do we avoid value traps in dividend investing? All right. So thank you so much, Ian.
Mm-hmm.